One of the most vigorous debates for investors nowadays is between those that support the benefits of electronic passive investing, typically through exchange-traded funds or ETFs, and active investing that depends upon a dedicated portfolio manager to make investment decisions. But this debate reveals a few flaws. Firstly, most of the active funds that are chosen for comparison are high-fee mutual funds that closely track an index, yet charge a hefty fee. Secondly, others may reference active management with high-volume trading and corresponding high fees. These are not the active management styles we endorse. Our active investment philosophy is best described as rational buy and hold. Despite active oversight, it is quite passive in nature, allowing the portfolio manager to make intelligent, thoughtful investment decisions on your behalf. Because the first use of passive investing was utilized by ETFs tracking the S&P 500, we'll use this ETF as our example. Firstly, why might one choose an ETF or index investing? One may choose an index approach with the idea that they can own the market. They wish for a broadly diverse collection of companies to avoid selecting the wrong one. In reality, the top 100 companies that make up the S&P 500 index account for 64% of this index. The middle 100 make up 17%, and the last 300 companies provide for just 19% of the weight of the index. You buy mostly the biggest companies. But because the company's size is measured by market capitalization, one way to look at it is you are also buying the 100 most expensive US companies. This may not be your intention. Some investors are looking for low cost. Ongoing fees are low, however, generally they do not include trading fees. That's why even with limited expenses, there is absolute certainty an index investor will trail the index they track by at least the associated costs. Index investing works well for those with limited means. Small amounts of capital buy a much larger variety of companies than could otherwise be accomplished. An index is simple and limited thought is required. Simply choose which indexes to track and move to investing autopilot. Why then would an investor choose our rational buy and hold method? Firstly, there is the ability to invest with much more specificity. The portfolio managers we utilize are looking for better than the market average. They choose only those companies that display attractive attributes, such as low debt, predictable earnings, a solid history of dividend growth, proven management teams, and other determinants to success. They have the ability to choose the price they pay for their securities. Often due to specific issues in one sector of the economy or temporary unfortunate events or press, companies may be out of favor and their price might be much lower than their intrinsic value. That may be exactly the right time to buy these companies, and the managers are able to do so. As well, they may find that a specific stock is overvalued compared to industry benchmarks, and so they may choose to sell or more likely trim that holding and reallocate some of that cash to other better priced assets. The portfolio managers are attracted to companies that pay consistent and growing dividends. Because the portfolios have this continual cash flow being paid into them, the manager can buy exactly the company they wish to buy when they wish to buy it. They are not forced to reinvest into the market average or index. Our investors also have the ability to be more tax efficient than the typical passive investor. By managing a basket of specific stocks or bonds, the manager can choose to wash capital gains with temporary capital losses between specific securities, since some sectors may perform differently at different stages of the market cycle. Passive indexes often move up and down together, and this reduces the ability to easily manage tax through this concept called tax loss harvesting. Additionally, our investors see exactly which companies they own. This high level of transparency helps our investors realize that despite short-term price volatility, there is little danger of their basket of businesses not managing to pull through the difficult times. Consider a business you interact with regularly, such as your cell phone carrier. Whether a recession hits or not, chances are you will continue to own and use a cell phone. Owning this type of business should provide you, the investor, with confidence to continue to own shares and not sell in a panic if market price declines. Lastly, and most importantly, our active style, rational buy and hold, has produced superior historical results. Over a 10-year time horizon or shorter-term results, these portfolio managers often provide investors with returns higher than index benchmarks. Warren Buffett says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Our portfolio managers, through their active management style, are able to do just that. For more information about our investment philosophy and the historical results of these portfolio managers, please contact us at blackburndavisfinancial.ca.